begin with, I warmly welcome Jeffrey Paine. Jeffrey, please introduce yourself and Golden Gate Ventures.
Sure. So thanks for having me. So my name is Jeffrey Paine, co-founder of Golden Gate Ventures, early stage venture capital fund based in Singapore. We have been around since 2012, investing in about probably 70 companies in the region.
Every fund has a unique purpose. So could you explain the type of the fund and its investment criteria and target?
First and foremost, we are early stage funds, so we do Series A and below. So pre-seed, seed, pre-AAA. So check size anywhere from $300K US to $2 million US. We are also agnostic. We invest in most sectors except maybe life science. And our strategy and themes change with every fund, and sometimes it even changes every 9 months. So at the moment, it will be a little bit more B2B, fintech, and deep tech, because that's just how the market is changing and moving to.
Looking at the Golden Gate Ventures track record, there should be some successful cases by now. So can you share who they are? And can you also provide insights into the exit strategy that you use and the lessons that you learned from those successful exit cases?
Yeah, there's actually a lot to cover. So I would say in general, we have maybe 60, 65 investments, about 9 unicorns, and then several exits. There are a couple of kind of IPO via reverse takeovers, right, like SPACs. There are secondary sales, and of course there are straight M&A exits. So generally, if the company is doing well, they are raising money, they have enough money, they're doing well operationally, and they are in multiple markets, they tend to go for a US IPO, and that typically will take about 12 to 15 years, which is actually quite different from what you normally hear, right? So most venture funds are between 8 to 10 year funds, and if your investments are exiting like in year 15, then you have to do a few things to try to capture that value. So one thing that I learned is the emerging market takes a bit longer to get to maturity, because because many reasons. One is you are new. 2 is when you are scaling, every country is different. 3 is it's also harder to raise capital as if you compare to the West. So things take a bit longer here. Now going forward, I would say the IPO market is still something that everyone wants to go for, but it's probably changing a little bit, meaning there will be small IPOs, potentially in the West, and then definitely in our region. M&A is still happening, but it's going to be slow. And secondary sales is probably where most of the activity will be. So if you're an early stage fund, it's actually more beneficial, right? You can sell at Series C, Series D. So growth stage funds is a little bit more challenging. But if you're an early stage fund, there's multiple options to exit. But exits are generally more tricky when you're coming from emerging markets, especially post 2022. So it's something that I think every fund and every investor will work doubly hard to make sure the funds are returned to the investors.
Which top 3 areas will you prioritize investing in over the next 3 to 5 years, and why? Like B2B, like AI?
So for me, I would probably just cover a few. One is I think AI is still relevant, I think, especially infrastructure side, database side, algorithm side,
Yep.
hardware side. And then AI in healthcare is going to be pretty large. So AI is still there. Of course, on the application layer on Gen AI is a little bit too crowded, but I think there will be a few winners. But it will kind of soften probably this year. But fundamental AI infrastructure is still quite important. I would say quantum is the next one. Quantum AI is quite interesting. Material science and chemistry-based startups will be something that I'm looking at, because all these three areas kind of they are kind of interlinked, right? So if you want better AI hardware, you have to invest in material science innovations, etc. So there's a lot of things that are intertwined.
Yep.
And then climate tech is another one. So climate tech is probably not going to stop, although there will be a lot of challenges because it's very capital intensive. But capital will still go there. So AI, climate tech for sure. Quantum is a bit far, but it's coming soon. And then material science companies, synthetic biology, this kind of stuff will slowly come. Now the problem is not the sectors. The problem is where we are. So if you invest in such sectors in Southeast Asia or in Singapore, you don't have a lot of those companies.
Yep.
And if you do find them, the quality may be a little bit suspect. So, but all this stuff is relative to what you do as a fund. Meaning, if your fund size is large, then your portfolios needs to be the top 3 or 4 in the world in order to return, your fund, right? In order to generate the returns that you want. If your fund size is small, then your expectations can be lower. But the problem is deep tech companies need a lot of money. They need a large return. So you're kind of caught in between. You don't know what you should be doing. So the formula is fairly straightforward. So going forward, B2B companies, deep tech companies needs to be as large as possible. Right? Then you don't have to be too conscious about, number one in Asia, number one in Southeast Asia, number one in Singapore, number one in Indonesia. You just have to aim as high as possible. The problem is just that, right? Number one, are you the top 4 in the world? And if you are, do you know how to scale globally? Right. So I think that's where the challenge for founders are for the next 3 to 5 years. And various governments have asked me the same question, like how do I generate unicorns in my country? And the answer is this: the startups needs to be top 3 or 4 in the world, and after that they need to know how to, go global. Right now we are fairly weak on both sides, both areas. So in the next 3 to 5 years, we need to, make sure we improve our capability on being technically very strong, and then after that, you know how to build products and you know how to sell globally.
Golden Gate Ventures is known for its investment in bold and innovative founders in Southeast Asia and across Asia. So could you provide the example of a startup that was particularly daring, and explain how it align with what Golden Gate Ventures is look for in a company?
I would say one example, like a quick example, is a company called Alami. Dima is the founder. So when we met him, he just finished his MBA, and he wanted to do something in Islamic finance because of his prior experience in Citibank. But it wasn't easy in the beginning. But he nevertheless pushed through it and made sure, he's delivering what the market wants and be extremely focused on, doing what he does. So I would say there are founders who are innovative, but they face challenges, but they keep pushing forward. And it's not like they are doing extremely well or they're doing everything's smooth sailing, but things are opening up. Things the market is understanding, market is adapting, market is beginning to be extremely ready for what he has. But I think founders do have to keep assuming that there will be pushbacks, but you just have to keep focused and keep believing in what you're providing, and just keep pushing it.
What's your opinion, like a syndicate investment for the early stage investors? So how the syndicate investment structures is working in Golden Gate Ventures?
For us, it depends on the stage of the round. So if it's earlier rounds, if the startup and founding team needs more help, a diverse set of investors are good for them. So we do tend to syndicate a bit more at the earlier stage. And then when there is some conviction of the company, we'll try to take as much as we can in the next round. But it doesn't mean we block out everybody else. I think there is a certain percentage that we are looking for. I think every fund probably has a certain way of modeling their fund. So anywhere from 5 to 15% is what we normally want to obtain from a company. Sometimes we invest from the first check and we get that amount. Sometimes we do a smaller check in the front and do a bigger check at the back. But the idea is to try to achieve the ownership within that range.
Within the range means a 5 to 10, right?
5 to 15. Sometimes more, depends. Yeah, but it's hard to say. Sometimes we might be the only investor, and then we take 25, and then over time it will go down. Sometimes we take 5, but there are multiple investors.
But how do you address these statistics that normally in venture capital market?
So I think what you're talking about is probably the power law distribution. So
yeah.
So we use a lot of that. So I think what we learned over the years is if you invest outside of the Bay Area, everything is not the same.
Yep.
And the typical power law statistics and the data sets are a little bit more skewed towards the Bay Area type of funds and investing. So out here, we've done our math. It's actually quite tricky. So what we model for is hit rates above 10x. So now we are doing maybe 18-19%. We'll probably we are using machine learning to try to bring it up to at least 30%. Now, the companies that can drive the fund, it depends on your fund size, right? So sometimes 30x doesn't hit your fund size. And the real unicorn numbers based on our data is around 0.3 per year. So it's not looking very optimistic if you are modeling just for unicorns. So I think it should be a portfolio base. It should be a percentage of portfolio that hits a certain average return. And then you have to drive, your investment strategy towards that. The other thing we do is to calculate the fund size. Fund size matters a lot in countries outside the US. So when we model our current fund, it has to be a certain fund size because mathematically, if it's above a certain number, you probably cannot hit 3x. So mathematically, it's actually pretty it's possible to figure out what fund size you should operate, and then how many deals that you should be doing, and then try to figure out how many percent of those deals will generate 10x or more. And then from there, you can calculate your eventual return. It is not an easy process, but it is not impossible to figure out. So I would encourage everyone to try to figure this out. Yeah, it's not that difficult.
How do you balance the time and the endeavor of your companies in actually supporting portfolios and also analyzing the portfolios like returns?
Oh, I guess you're asking how do we spend time on selection and portfolio management? Is that right?
Yes.
So the hypothesis is it's probably 70% selection, 30% portfolio management. Because if you
70% selections and 30%.
Yeah, that's just based on data. So if I think you probably can look at examples everywhere or even in Korea. The best companies actually they don't really need that much help, right? They can kind of figure it out. But are you able to structure your portfolio where everybody don't need help? The answer is no, right? Mm-hmm. It's probably 30-40%. If you do your best, it's probably like 40%. And then 20%, no matter what help you do, they will still die, right? And then you have the remaining 40% that always needs some help. For many reasons. Sometimes, they are first-time founders. Sometimes they are second-time founders, but they are doing a different sector. Sometimes they move from B2C to B2B, right? So they need help along the way. Sometimes when they pivot, they need help because there are things they don't know, they don't understand. So for us, it will be a little bit more skewed towards selection and thesis development and market research, so that we know for a fact that which business models will work, which business models will generate venture returns and not PE returns. PE means private equity returns. Which business model, the timing is just right, not too early, not too late, etc. Right? So there's a lot more thinking and more analysis before doing a deal. And then portfolio management is also important because if it's 30-40% of the weightage, it is important. The reason is there are things that the founders don't do every day. For example, fundraise. Right? They don't fundraise for a living. They don't do that every day. They do that once in 18 months, 24 months. So there are things they don't know. There are people they don't know. There are terms they don't know. There are trends they don't know. Right? So this is probably where we add the most value, is to make sure they understand what's happening in the market. Should they raise money earlier? Should they not raise money? What terms are normal? What terms are not normal? Who is investing? Who's not investing anymore? Right. These are the things that we can definitely help a bit more. Right. And then everything else tends to be high strategy kind of advice. Right. Like sometimes it's should you buy this company to expand? Sometimes should you expand on your own? How should you expand? That kind of thing. So I think founding teams tends to be, there's always gaps. Sometimes they can fill it themselves. Sometimes they need a bit of help. But I think portfolio management tends to be a little bit more fundraising. In the past, we've helped them with growth marketing. We've helped them with recruiting. But usually what they do need help with is, some normal governance stuff and more strategy advice, more coaching, and then fundraising. So fundraising seems to be the most common common ask that everybody needs help with.
How does like a GPT language, like models or experience, impact your venture capital management or portfolio management or analysis, venture capital investment strategy?
Yeah, so we use it for some of our workflows. It's usually a fun experiment. Like we experiment whether we can do deep market research purely entirely on prompting, and the result is quite accurate. So even if it's not tabular data, machine learning, just purely LLM. LLM analysis. There's some there's some things quite interesting. So the reason is, I would say, there are usually blind spots that you don't normally uncover, and some of these blind spots, you can see it once you run that analysis. So I would say it's an inevitable thing, which means every business you can use LLMs to kind of optimize different workflows, different processes, and it should be. It definitely is beneficial. So we have used different types of things to do different types of work. Even cleaning my data set, maybe drafting some market research report or drafting an investment memo. We've done different things. We have done analysis of research papers and try to figure out what deep tech companies are spinning out soon. So we've done a lot of weird things, but it should be pretty exciting, right? So if you are a technologist or if you are a VC, angel, or even a founder, all these tools are quite interesting for you to experiment.
Golden Gate Ventures is expanding into other countries like Middle East or some North Africa. So how does your VC firm global expansion strategies is like, and how do you see the opportunity in other regions?
So the MENA region is probably the next region to explode, and you can kind of tell from the way the consumer consumption looks like. So from Turkey, Egypt, Saudi, right, the largest countries, and then you can go down the list. Things are changing. So for us, since we've done emerging markets in Southeast Asia, Southeast Middle East is not entirely that different, although it is culturally fairly different. So we have seen it before. We kind of know, what it takes to get things done. So yeah, we're working with local partners, so that the learning curve is not that steep. Although I used to live in Dubai, so I understand the culture very well. But the broader MENA GCC is actually fairly large, and even navigating around Turkey is something I'm not very used to, and even Egypt, right? So it's quite different. But that's not. I think the investing side is one part. The other part is actually what I normally advocate to government fund of funds, right? So whether Korea, Malaysia, or New Zealand, if your local funds needs to be able to invest elsewhere, because that's the way your investors can build their own network to help other portfolios expand over there.
Yep.
Right. So the reason we are doing it is because we have a lot of portfolios, right? At least 20% of them are looking to expand in the Middle East. So if we have no friends, no partners, don't know anything about the Middle East, we cannot help our portfolios go over. So even if I've lived in Dubai, it doesn't mean I can help them in Qatar, or I can help them very well in different parts of Saudi.
Yep.
We still need experience, network. We have to build that network, and as you probably know, the way you build network in the Middle East is quite different.
Yeah,
right? It takes a lot of time and a lot of effort, and and a lot of commitment. So imagine founders who have never been there, and they want to get plugged in and and do business right away. The reality, it will take them a while, right? So you do need a go-between. You need someone to help you out. So I think market access is probably the more important reason why we are doing it there, because we recognize a few things. Very few of our companies, expand to India. Almost none expand to China. And then the best global guys, they kind of understand how to go to the US, right? Latin America is not what we do, right?
Yep.
And Africa is too early. But B2C and especially B2B, the Middle East is actually quite ready for us. They are very used to us. They have worked with Singapore government for a long time. They have relations with Malaysia, Indonesia for many years. Right. So it's fairly natural to go over. It's just that we were too distracted and it's too far away. But as far as markets opening up and receiving and being very receptive, I think the MENA region is very poised for our companies here to expand into.
A lot of founders change their deck based on the feedback each time. How do you advise for the early stage founders in building up presentation pitch deck?
Pitch decks, I would say there is a certain format, right, and certain things that you should include.
Yep.
I will recommend the Vinod Koshler pitch deck, right? So he has something online. Vinod from Koshler Ventures has a pitch deck kind of template. Just follow that, then there is no problem. So now, you want to have a set structure and set format, and then what goes in is you are pitching to an investor who do not understand what you're doing, right? So, for example, a family office who do not invest in tech, right? So that your content is a bit more dumbed down, it's a bit more simple, easier to understand. Because pitch decks, typically you have 15 slides for show, and then you may have another 20 slides at the back, right, for appendix, right, which is a little bit more technical. So the 15 slides is to educate and to interest people. Right? Your job when you're pitching is to interest them to talk to you more, or interest. So let's say a half an hour pitch turned into a 2-hour in-person chat. Right? So it's a natural thing. So you pitch for interest, and then if they ask you technical questions, your answers are at the back in the appendix, and then you just pull it out and show them. And the 15 slides should, from your ex-boss to a deep tech investor, right? So as long as any one of them understands it, you are fine. And be as honest as possible. That's probably the harder part.
Yeah.
Right. So if you are not worth 700 million in 10 years, just say that. Right. So don't overinflate it. Don't over exaggerate anything. Be as truthful as possible. If your model is not right, make sure you get it right. Right. Your financial model, like your 3-year plan, 5-year plan. If it's not ready to show anyone, don't even pitch yet, right? Make sure everything is as predictable as possible, meaning as transparent and honest as you can. And then just keep doing it. I think the more pitches you do, the more you'll be tweaking it anyway. The more feedback will come back, right? And then some feedback will be very good for you. So sometimes investors who wants to give you honest feedback will tell you, your model is a little bit too over exaggerated, or assumptions are a little bit off or weird or whatever. So the more you do it, the more feedback you get, and then you kind of like slowly self-select the feedback and try to incorporate the feedback back into your deck.
What factors do you see like a negative signs in when you review the deck make you uncomfortable or lose confidence of the company?
I think, I don't know, I think the main one would be like market sizing and go to market. Right? So market sizing cannot be too top down. It has to be as real as possible. If you're too top down, that means you haven't done enough research or homework, or you don't dare to tell me the real number. So if you have very big numbers, there are two reasons. One is you haven't done the research yet, or you're hiding the real number.
Yeah.
Like you know the number, but you're hiding it, right? So the market research, the market size part is the one that is a bit more. It has to be a little bit real, more realistic, and it's also related to your traction, right? So the more traction you have, the more you understand the market size, right? So before you have traction, your market size will be very big, right? But once you have traction, then you realize, okay, it's actually not very big, right? Then you'll be a bit more honest. But some people don't put the honest content there; they still kind of leave it out, right? Yeah. So it would be weird if there is traction and the market size is very big, and there's not much detail on how they get there, right? Then it's obviously they haven't done homework or they're hiding something. Typically, if you have traction, you probably already know how to go to market. You probably know how many sales guys you need, how much money you need, how long does it take for you to sign a customer, how many % will churn, who will use it, who will not use it. You roughly know, right? And then from there, there are customers that you can never sell to, that will reduce your market size, right? So after a while, you kind of know. The question is, do you dare to put it down on the deck? Right? Most of them will just leave it off the deck. Then the detail go-to-market is also another thing. Now, if you are a technologist or you're a PhD, you're just spinning out from a university, then it's okay because you don't really know how to sell. It's okay. But if you have a full team, raise some money, have traction, then your go-to-market will be very clear, right? It should be very clear, right?
Yep.
Because you have done it multiple times, so it should be documented how you do it, right? So these are the two things. Other than that, there's nothing really. I think what you do, which country you're from, how the team look like, it's all different. Yeah. So if you follow the structure of the template, I think you wouldn't miss out the most things. But I think one slide that the Vinod Koshler template has that a lot of founders don't put is the risk mitigation slide, which is quite unique, right? It's a slide to list down your risk.
Our risk.
Yeah. And then how do you mitigate it? Like how do you solve and fix your risk, right? So this if you can list out your risks, that means you understand your business very well and you are very transparent, right? You tell me where are your risks. You're very transparent with me.
Yep.
And then you have a solution for your risks, right? That means you have showed me that you have thought through everything that will go wrong with your company. And then you have thought through ways I can stop that happening, right? So that is actually a good slide to have, right? To show that you actually have thought through everything, including how you will die. So the slides shouldn't be positive all the way. There should be some ways of you dying, and there are some ways of you stopping yourself from dying. Because startups are difficult. There's no such thing as an easy startup, right?
But why do you think that companies die? Like you have companies, like closed companies in portfolios. So why do you think that companies die? Like a founder's mistake or the industry collapse or team culture? There are so many reasons, I know that, but in your like personal just mind or personal thought, what would be the like a top 3 some reasons why the companies fail?
I would say the product market fit is actually an important thing. I think it's a very common answer.
Yeah.
But there is more to that, right? So Your product needs to fit the market at the right timing, and you need a way to make money. So there's many answers to the product market fit answer. And then your market cannot be ready but small. Your market cannot be ready and they don't want to pay you, right? And then your market cannot be ready and there are 200 competitors. So there are many smaller reasons within a bigger reason. So if product market fit is one main reason, then there are probably like 25 reasons below that. And this is just purely product market fit. There is still competition, there is still the team, there is still the culture, there is still other things, right? So if you combine all the other small reasons, it's probably over 50 reasons, right? Of which one or two reasons can kill the company. So that's why a startup has many risks, and you have to try to de-risk them, right? So that from 50 reasons, it becomes 10 reasons, right? Because and that's the reason why people don't invest very early stage, because it's very high risk.
Yep.
Because there are 50 reasons you will die, but maybe after 4 years there are only 5 reasons you will die, right? But by then you probably do very well. By then your valuation is very high, but that's okay because you are de-risked, right? So that's the part where every round you are trying to de-risk a bunch of things, right? Technology risk, market risk, people risk, whatnot. But I would say the main issue is usually product market fit, because if you can build a product, your team should be pretty good, right? If you time it well, you can compete with other people, then your team should be pretty good. It's kind of like if you get your product market fit right, it also means your team is good. But it doesn't mean your team will not change to be bad, right? Because things is a constant change. Everything is changing. People are changing. Teams are increasing in size. Things happen, or people are leaving, etc. That's why it's a little bit more complicated. But I think the main reason is product market fit, traction, performance, growth. Because if you have typically good traction or good product, you probably can raise money. In Asia, it's less of a good product. It's more good traction, and it's less of a good team. Right? In the US, team, product, traction. You have one of them, you can raise money. Out here, it's usually traction first. Team, you can raise money, but if you have no traction, you still die. Right? Good team, your market size is small, you will still not raise money after a while. Right? If you have a good product in Asia, it doesn't mean anything, because good product means you must have good traction. Right? In the West, sometimes a good product means it's highly innovative, which means even you have no traction, somebody will buy you.
Yeah.
Right. Now, over here, not necessary. If you have good traction, if you have good product, doesn't mean anybody will buy you. They don't care about you until you have traction, right? So most of the time, the arrow is pointing at traction, right? Which is, I guess, a result of product market fit.
What aspect is different from Silicon Valley and Asia founders in generally?
I think the Valley has a few things. One is they are exposed to a bit more things, right? So they are able to see the future a little bit clearer. Two is their confidence level is very high. Yeah, so these are the very clear things that you see. So for example, if you go to the US, you will quickly realize there are way more companies doing way more things that you have never heard of before, right? And then when you shake hands with the founders, everybody wants to help you, right? Because number one is culture. Number two is they are confident, right? They want to show you the ropes. They want to show you, I can do it. I know how to do it. Let me help you out, right? Lastly, when you go to any meetups and events and you hear people pitch you their startup, you realize their startups are also very bad. But then you look at them and you're like, how come you're so confident in starting a bad company? Right? So you are like questioning yourself, like, what are these people doing? Why are they so happy pitching a stupid company to me? Because their confidence level is different It's a different thing. They're in a different sphere. They're in a bubble of their own. So the more, I would say, that's the difference, which means I think Asian founders needs to spend a bit more time in the US. Number one, you want to close the gap on looking at the future, right? It's not so hard. You just have to do a bit more homework, do a bit more coffee meetings, and visit some offices and see what they are trying, what they are testing, what they're doing research on. Then you can kind of tell, okay, these people are a little bit different, or their training is different, meaning they went to different schools, they study something different, or they work for some companies that I've never seen before. That is the reason why they are doing like futuristic things. And then you realize there's a lot of money in the US. Right? Yeah, it goes to all kinds of companies that you have never seen before. And you are a little bit envious of that. Right? You're quite jealous. Like, how come these guys can raise money for something that's a bit weird? And you know for a fact, in Asia, you will never get that money because nobody understands how to invest in it.
Yeah.
And no founders can come out with that idea anyway. Right? And then the longer you stay in the US, you will realize, although the depth of talent is very deep, but they are still very normal people.
Yeah.
Right. So even though, yes, the depth of talent is good, but the more founders you meet, the more you realize they are similar to you. Right. Which means if they can do it, you can do it too. Right. So the more you spend time, your confidence level will go up. Right. So number one, you can reduce the gap to seeing things in the future. Number two, your confidence level will go up. And then when you go back to Asia, you will be very clear that you're way more confident, right? Because very, very few Asian founders spend time in the US, right? Even Asian VCs don't spend time in the US.
You consume a lot of information, internet, like in Web3, AI, statistics, and news, and you also publish a lot of research. So how do you manage this? It's like a personal question. How do you manage all this information, and then how you turn this information into strategy or some maybe business proposal?
I think we started this in 2019. So we started analyzing trends and using different databases and scraping tools and that kind of thing. The reason is it's a fairly straightforward reason. Most of our top companies, even in Korea, in Asia, most of our top companies are copycats. It's like 98%. Some regions is 100%. I would say 70% of venture value around the world comes from about 70 VC firms. So that means if you are tracking the portfolios of the 70 VC firms, the next unicorn in Southeast Asia is a copycat of that. Right? It's not that hard to figure out. The problem is 5% of VCs actually makes 3x the fund. That means 5% of VCs are actually doing well. 95% are not.
Yep.
Which means of the 70 VCs portfolio, majority are not going to work out, right?
Yep.
But the problem is the founders here copy them anyway. Right? Irregardless, if they raise 300 million, they are 7 years old, they will still copy, and then they will die after that. They will still copy, right?
Yep.
So investors needs to know from the source, right, whether that business model actually will work in the first place. Not it will work in Asia. Will it work in the US in the first place?
Okay.
Right. So then we started analyzing companies' business models in the West, not in Southeast Asia, because we assume the copycats are coming. Right. So there's no point analyzing them when they come. I start to analyze them when they start. So that's how this thing came about. So we started using more data science databases to kind of crunch different things, and then we track. Right now we are tracking about 1,300 business models around the world. 1,300, yeah, and it goes up between 3 to 5 every month. we track, are they doing well, not doing well? Are they ready for Southeast Asia, not ready for Southeast Asia? Do we have the talent to do it, not have the talent to do it, right? So that's why our thesis change every 6 to 9 months, because I'm tracking them, and then I'm doing research. So we are a little bit more thesis driven. We are majority outbound, right? 70% of our deals are outbound. We kind of know what we want. We go and look for them. So it's a lot of reading, a lot of but you cannot just read everything. You need to, put a kind of database together to figure out what you want to read, and how do you classify them when it comes to you, right? So we track momentum, we track like research grant momentum, we track venture funding momentum, we track who is starting what companies, who are these people. So if there are A-list founders starting companies, we want to know what are they starting, and then you can give some momentum scores on, okay, this sector is growing because of many things happening, and then from there I will try to figure out why is it happening, why is it growing, that kind of thing. So it's a little bit more than just having a database tracking, like putting email alerts and tracking. It's a lot more than that. So every sector we spend 3 to 5 months researching whether it will work in the first place, and then whether it will work in our region, right? So we do double the work, right? The VCs may do research on whether it works in the US, but we have to do both. We have to make sure it works in the US and works elsewhere, because we are investing elsewhere. And the reason is most founders will copy. So we need to know things the founders don't know, because we are usually 6 months ahead of them before they copy. So by the time they talk to me, I understood their business for 9 months already. So the conversation is slightly different, right? So we don't react to deals. We try not to react to deals. We already know what we want, so it's much easier to talk to founders. But is that a lot of work? Yes. Is it a lot of fun? Yes, because you're learning new things all the time. And you probably need to be a little bit more focused, right? Because there's a lot of things to look at. And then many themes are too early for Southeast Asia.
Yep.
Which means I have to relook at them again. After 6 months, I have to relook at them again and try to figure out, is the time now? So we do have a timing issue, right? Usually companies fail in our region, especially B2B, is because you're too early. But that's something that needs a lot of a lot of work to figure out. Founders sometimes don't necessarily have that time to do the research, unless they came from that background. Those guys that don't need so much help because they've seen it, they've lived it for 2-3 years, they know what's missing, and when they launch something, it's a little bit, the timing is a little bit more accurate.
If you are not running a Golden Gate Ventures anymore, for example, just assumption, you can start a new company just tomorrow out of just anything. Like it can be startup, venture capital, maybe corporations, maybe free life. I don't know what it is, but what do you wanna start as a new business?
Yeah, I don't know. I think there's a few. I think there's the healthcare side of things. There is potentially a reinvention of VC, right? So for me, it'll be a VC fund that is entirely run by AI.
That sounds exciting.
Yeah, and then it could be a SaaS tool for VC firms, where it's just me and 2 part-timers, right? That kind of thing. So like really small businesses, no board members, no investors, just make money from day one, that kind of thing. Yeah, and then the healthcare side is more, it's more altruistic. It's more like, you want to help solve something, solve cancer or longevity or whatnot. But it doesn't mean I can do it. It's just one of those things. Yeah.
What's your a personal goal in your life?
I guess just be happy doing what I'm doing. and keep learning. At some point, we'll keep teaching. Right? I'll start teaching. At some point, I'm starting to. So so I'll keep learning. I'll keep studying. I'll keep teaching. Yeah, if VC is my thing, I'll keep doing it. I think it's more like I think different stage of life, you kind of like be happy on a minute by minute level. I think life is extremely complicated. So
Yep.
So for me, it's more like learning. Learning about everything, which is very deep. But but generally just being happy every day.
Jeffrey, please share your maybe some advice for the founders in Asia. You mentioned about confidence. What would be like a top, just one advice for the founders in Asia in general so that they can succeed in their own life?
I think if it's the business side of things, the advice would be build what you want to exist in the world, and then be very honest where it will go. Right, like 5 years, 10 years. Be very honest to yourself, to your team. How big it will be, and if you're honest, then it should be fairly straightforward, right? Because you are not over exaggerating. You're not setting too high a goal that you cannot reach. You are not getting the wrong investors, right?
Yep.
Because if you're selling too high, then the investors expect too high. And if you cannot get there, you get into trouble.
Yep.
So be as honest as you can, and then just go out there and do it. Now, along the way, things will happen, right? Sometimes somebody will buy you. Sometimes you encounter something way bigger, and things will change. But at least start with a vision and start to be extremely honest about it. And then when you're honest, the right investors will come, because they can see that you're honest and they are fine with that growth, right? Whatever growth you're telling them. And then there will be less friction, right, during board meetings, etc. So be as honest as you can. Then on the life side, I would say understand yourself a bit more. And then over time, focus on things you like to do. And delegate away things you don't like to do. Right. So for example, me, I like to do research and machine learning. So I'll do more of that over time.
Oh, okay.
And the more you do that, the more you like to do something, the more you're good at it. The reason why people get burnt out is because they're doing things they don't like to do.
Yeah.
Right. And it's not just that. It's the reason people get burnt out is you have things you can do, but you didn't do. So you get stressed. But the reason why you didn't do it is because you don't like to do it. Right?
Yep.
So imagine your entire day are tasks that you like to do. The chances are you will never have burnout. Because you love to do it, right?
Yep.
Which means every morning you wake up, go to work, you are happy. Right? So first thing is just understand yourself, and then make sure the more you are doing things you like to do, the less burnout you get. And burnout equates to less stress. And less stress equates to less mental health issues.
Makes sense.
And then if you have mental health issues, please ask for help. This is no laughing matter. Because founders in 2024, I think many of them are at the breaking point already, because in 2022 it crashed. 2023 it crashed further. 2024 should be better, but you have almost 2.5 years of really, really bad kind of thing. So many founders are breaking at the moment. Right. So if you find yourself, let's say not sleeping, right? If you sleep 2 hours a day and you think it's normal, it's not normal. Right. Yeah. Just watch yourself and ask for help.
I'd like to extend my heartfelt thanks to Jeffrey Paine for joining us today and sharing his valuable perspective. It's been truly enlightening discussion, and I hope our audience has gained a deeper understanding of the dynamic world of venture capital startup industry. Okay, thank you, Jeffrey, again.
Thank you.
And we
Take
look
care.
forward to seeing your continued success and innovation that Golden Gate Ventures bring to the global startup ecosystem. Thank you so much.
Thank you.